Welcome back, everyone. Today on the Joseph Carlson Show, I sold a stock. Rather, I trimmed it significantly. I sold about half my position in one of my key holdings that I've held for around 5 years. This has been a massive winner in the portfolio, a company that I've talked about frequently. I'm excited to go into the details, explain why I'm taking gains in this company, and which stocks I'm buying with the proceeds. So we'll be looking at the entire trade first thing in this video. Now, we also have a lot of other news we'll be getting into in this episode, including the software is being eaten by AI narrative. That is a theme that's been around for a couple years now with Wall Street. There are people that believe that artificial intelligence is going to replace software companies. I'll be highlighting a couple reasons why I don't think that that's going to be the case. Now, we also have a lot of other news. Apple is now going full speed into robotics. This is the first bullish thing I've heard from Apple in some time. We also have news that Perplexity is offering to buy Google Chrome with a complete bogus offer. We'll be looking at that publicity stunt. Mark Mahaney, the Wall Street analyst, outlines why his top pick is now Duolingo. Amazon is pushing full ahead into grocery, competing with Walmart. Paramount Plus bought the rights to UFC, so Netflix isn't getting that. I'll share some thoughts on that, as well as our own Qualtrim.com. The website that I created and was used on Fox Business News. We'll be looking at that segment as well. So we have a ton of news to get into in this episode. Let's go ahead and jump in. Now, we start things off today by looking at my latest trade. I'll go over it real quick. We have it here in the passive income portfolio. This is my larger of the two portfolios, with a current value of around $908,000, $351,000 of that being gains. When we look at the trade, it's fairly simple. I am selling $30,000 of my Texas Roadhouse position, locking in substantial gains, and I'll be deploying that capital into 3 separate companies. Now, if we look at the holding right now, before I execute this sell, Texas Roadhouse is a $75,000 position. It's massive. It's one of the biggest positions in this portfolio. $40,000 of that, in fact, $41,000 is gains. So the majority of this position is made up by gains. It's just, quite frankly, been an incredible outperformer. In fact, Texas Roadhouse has not only outperformed many of the companies in my own portfolio, but it's outperformed most of the companies in the market since purchasing it. If you look back over the past 5 years, Texas Roadhouse has outperformed companies like Microsoft, Meta, Google, Amazon. Many top tech companies, it's done better. It's outperformed the QQQ. And it's done this by having incredible fundamentals. Texas Roadhouse has grown its revenue at a substantial rate over the past decade. In fact, it's been growing around 17 to 18% revenue. That's very fast. It's also accelerated the pace of growth after the pandemic. So during a time period where other restaurants were struggling, Texas Roadhouse gained market share. They took market share from other restaurants like Cracker Barrel, other ones like Outback Steakhouse. All these companies were struggling while Texas Roadhouse was continuing to climb. Now, it's also grown in its earnings per share at a high rate, beating out most companies, growing around 18 to 20% for the past 5 years. So we have incredible acceleration in the earnings per share growth and the free cash flow per share and all the other metrics. When I look at it today, there's a couple reasons why I'm locking in some gains and trimming this position. First of all, the valuation is simply higher. When I bought the company, I was buying it at a valuation of around a 4 to 5% free cash flow yield. So we look at this metric, and I was buying it right around here. This is a 5% free cash flow yield. For every $100 I invested, I got back 5 per year, and that free cash flow grew. Today, Texas Roadhouse sits at more of a 3%, 2.7%. So the free cash flow yield is down around half, meaning that on a free cash flow basis, the company's roughly twice as expensive as when I first bought it. And while the valuation has also increased, the growth rate has also come down a little bit. Texas Roadhouse recently grew revenue by 12%, a slight deceleration from the 16, 17% it was growing. So we have an increasing valuation. We have a little bit of a deceleration in growth rate. None of this is terrible. It just means that Texas Roadhouse is not quite the deal today that it was 5 years ago. On top of that, I noticed that a lot of competitors, like you can take Chili's for example, have gotten their act together recently. Chili's has upgraded their kitchens, they've redone their service, they completely redid their menu, they've lowered their prices. They're competing a lot more fiercely with Texas Roadhouse than they have before. And so I see a little bit of increased competition as well. Now, it's always difficult to sell companies that have done really well. They're great performers in the portfolio. They're companies that you might even have a bit of an attachment to. Texas Roadhouse has been a company that I've talked about forever, so it's difficult to take any gains out of this company. But you have to do what you feel is best as an investor. And I don't believe having a small market cap restaurant company as one of the largest positions in my $1 million portfolio is a smart move. So what I'm doing is I'm simply paring down the bet, making it a little bit smaller relative to the other positions. Now, with the $30,000 of gains, the proceeds from this sale, I'm going to be rolling those gains into 3 different companies, ones that I believe today offer a better risk reward. We have Equifax being one of them. I'm going to be buying $10,000 more of Equifax. This is one of the newer positions. Equifax is a deeply embedded, data-driven company. They are accelerating the growth of new products. They already have an incredibly entrenched position with the Work Number. They have pricing power, and they're heavily diversified. Now, the next 2 that I'm buying are in the tech category. I'm buying $10,000 more of Google. Google has done incredibly well recently. The stock has had a big resurgence, but I still believe there's more room to run. Google, if you can believe it, trades at a lower PE ratio than Texas Roadhouse. So even though this company owns YouTube, it owns Waymo, it owns Google Cloud, it owns a ton of businesses outside of its core business of search, and it's still growing at a high rate. It's just incredibly powerful. It trades at a 20 PE. So even though the stock has recently done well, and I believe investors are starting to get back on board Google, I believe there's more room to run. Google should trade at a 25 PE ratio. It should be 30% undervalued today, plus it's a heavily entrenched deep moat business. Then we have the third one, which I'm buying with the remaining $10,000, which is ASML. This company is also deeply entrenched with its technological supremacy with its EUV lithography machines. They make machines that nobody else knows how to replicate. They can't even figure out the technology behind it, and they have the distribution. And over time, ASML has a huge product pipeline. They've projected revenue a decade out. The company is incredibly insulated from competition and should grow cash flows continually over the next 10 years. So this is another company that's deeply entrenched, very wide moat, has technological supremacy, but it's trading at lower valuations. So simply put, that's the trade. I'm taking $30,000 out of Texas Roadhouse, which has grown to a large position. It's been a big winner. And I'm moving that money, $10,000 each, into Equifax, Google, and ASML. Now let's go ahead and move on to some news. Now the first piece of news we jump into is addressing this narrative of AI eating software. For a long time period before artificial intelligence, we had the narrative that software was eating the world. Software were the most powerful companies. They're high margin, reliable income, subscription based. They just grew and grew and grew, and they were very profitable. Software companies outperformed the majority of other companies in the market. But now since AI has come along, it's changed the narrative dramatically. Investors are now very concerned that artificial intelligence is going to make companies like ServiceNow and Salesforce eradicated. They're simply going to destroy them slowly, one bite at a time. We have different people on CNBC, different analysts like Jefferies Brent Thill, saying that this is a problem for software.
Yeah, I think the application software sector has been crushed. I mean, you look at Salesforce, you look at anything in applications, it's all down, Monday included today. So I think that category is the category that's been hit the hardest. And it's
the category that's been hit the hardest by this narrative is the application software category. Companies like Salesforce and ServiceNow. Now, again, this is a narrative that's been around for a while, but part of what's reignited this narrative just recently, just of the past week, is a guy named Ben Reitzes. Let me read a bit of a summary of this note that he published. The core argument is that while software has been eating the world for the last decade, now AI is eating software. This shift is causing investors to reevaluate the stock valuations of SaaS companies. The thesis draws a direct parallel between the rise of AI today and the rise of cloud computing years ago. In the past, companies maintained expensive on-premise data centers, which was good for hardware providers like Dell, HP, and IBM. As cloud services like Amazon Web Services and Microsoft Azure emerged, these on-premise hardware companies saw their valuations plummet, and their price-to-earnings multiples contracted sharply. Today, SaaS companies with their seat-based subscription models are seen as being in a similar position. Melius Research argues that the rise of AI tools, particularly agentic AI, that can complete tasks without human intervention, will allow companies to become more efficient, productive, with fewer employees. This directly threatens the SaaS business model, as it could lead to significant reductions in the number of paid seats that companies need to buy. Now, this note goes even more in depth along the lines of this argument, but this is the reason why you've seen a huge fall in stock prices of companies like Adobe, Salesforce, ServiceNow, and Monday. Investors are very skittish about this thesis that AI is eating software. Now, every narrative like this has some truth to it. Artificial intelligence is changing the dynamic of how software is developed, the type of tools that we use, and agentic technology is real. It can be useful in creating more efficiencies. But the argument here also leaves out a lot of counter arguments, things that are important to look at when we're assessing whether or not AI is going to replace companies like Salesforce, companies like ServiceNow. One of them is that if these tools do make companies far more efficient and productive, that should also apply to these software companies themselves. Companies like Salesforce and ServiceNow should be able to push out products at a much faster cadence. If they do use agentic technology like this bear case is outlining, then that should also be applicable to these companies. They should have fewer employees doing more. Their margins should go higher. They should also be able to use their massive distribution they already have to implement these AI tools to their customers in a very structured way. Now, with every bear case, there is some truth to it. And I'll acknowledge that artificial intelligence is changing things dramatically. It does make employees more efficient. You can just look at ChatGPT or Google Gemini. You can see that it does a lot of work for you. It speeds things up. But that doesn't necessarily mean that these companies will have fewer and fewer employees. In most cases, when an employee becomes more productive, when they get you a higher return per employee that you hire, you want to have more of them. That makes employees worth more. When something is giving you a higher return, you want more of it, not less. So while there may be some short-term margin gains from some companies laying off some employees, most companies that have higher productivity per employee are going to hire even more. They're not going to reduce their budget. They're going to increase their budget. It's the same thing that I do. If I have an employee that's twice as productive, I want to give that employee more work. If agentic technology helps the employee become twice as productive, I want to pay them more. I want them doing more. So I don't believe that this is going to be a case where agentic technology makes it so all these companies lay off half their employees. There may be some short-term firing going on, but that is the cyclicality of the market. Over time, companies will hire more and more people. And it also stands to reason that if these companies did theoretically fire half their employees, if suddenly half the workforce was gone on all these different companies, people that know how to use technology, people that are in the marketplace, wouldn't they start new businesses? Are we assuming that they'd never start new companies, especially with AI tools that make it easier to start new companies? Would those companies never need software to manage customer relationships? I don't believe that that's likely. The products that companies like ServiceNow and Salesforce provide are solutions to very common problems companies have, which is simple relationship management, having sales funnels, conversion funnels, reaching out to customers, tracking tickets, things that companies don't want to focus on themselves. They want to focus on their product, the thing that they offer that's of value. They don't want to rebuild a whole structure of managing customer relationships. So I don't believe it's as easy to replace companies like Salesforce or ServiceNow that these type of analysts would have you believe. It is true that if you look at the stock price, companies like Salesforce are just getting obliterated. It's down to $233 per share. Sentiment has literally never been lower on this company. I've never heard such negative talk about it ever. And if we look at the actual fundamentals, I just want to show a couple things here. Salesforce is now trading at a 5.6% free cash flow yield. 5.6%, even when you factor in stock-based comp, it's 4.21%. Now, there's an idea that Salesforce pays their employees too much. They're just a highly dilutive company that has way too much stock-based comp. But the stock-based comp has actually come down dramatically relative to their free cash flow. Over just the past couple of years, they've really gotten this under control. We can take a look at it right here. Here's their free cash flow. Here's the free cash flow against the stock-based comp. For the past 2 years, stock-based comp has been flat and free cash flow has over doubled. So they are getting the stock-based comp relative to their profits in order. It looks far better now than it did just in 2022. In fact, if you have criticisms about Salesforce's stock-based comp percentage, Google also has a 25% stock-based comp impact. In fact, Google's is slightly higher. So Google has a higher impact to stock-based comp than Salesforce. We can look at Meta. This is another company that has a lot of stock-based comp, even more relative to their free cash flow than Salesforce. So Salesforce is less dilutive by paying employees through SBC than either Google or Meta. The whole idea that they're this highly dilutive company, they just waste money on employees, that's an idea that's 2 years old. The narrative hasn't changed. Most people aren't paying attention to the numbers here, but Salesforce has addressed those concerns. They've said that they're never going to have stock-based comp be more than 8% of revenues. And over time, that scales better with the profits. So we'll see this stock-based comp impact go down over time. With a 4.2% free cash flow yield, this makes the company roughly half as expensive as Google. It is trading at an incredibly low valuation. Even the PE ratio on a forward basis is a 19. On a trailing basis is a 36, and this is for a company that's rapidly increasing margins. Even with the dilution from their stock-based comp, Salesforce reduced their shares outstanding by 1.5%. They're paying a growing dividend. They're returning more and more capital to the shareholder every single quarter. When we look at their expenses over time, their expenses have been flat while revenue continues to grow. This is a company that's exercising operating leverage. They have fixed expenses with revenue growth, so the margins are going up as a result. Gross margins are increasing, 78% now, higher than Microsoft. We have operating margins at 19% and stepping up every single year, and we have profit margins at 17%. Also stepping up each year. And while this is happening, Salesforce quite literally trades at the lowest valuation on a free cash flow basis over the past 5 years. It is now at a 5.5% yield. It's never been this high before. We look at it on a price to sales. Lower means cheaper. We look at it right now, and it's not the lowest, but it's getting close to it. The lowest was during the complete trough in 2022 when the entire market was selling off. The biggest criticism that you can give for Salesforce is that the revenue growth has decelerated. A lot of people have outlined this as a substantial problem, but keep in mind, as their revenue has decelerated, their operating margins have skyrocketed. So the revenue deceleration should be paired with increased operating margins. And they've guided for continued expansion in operating margins, as well as guided for 8 to 9% revenue growth. So they're guiding for increased revenue growth, increased operating margins, and if we look at the company's total performance obligations, which is contract growth, this is the amount of companies that in the future have decided contractually to do business with Salesforce, it grew by 13% last quarter. So the pool of revenue they have to pull from contractually, that pool is getting bigger. It's growing faster than their revenue growth rate. So we have a company that's growing revenue, it's growing operating margins, its free cash flow per share is at all-time highs, it's doing share buybacks, reducing the shares outstanding, it's gotten its stock-based comp under control, it's at a record low valuation over the past 5 years. But if you're listening to the media and these analysts, the impression you'd get is that this company's being eaten alive. The artificial intelligence is destroying Salesforce. Except for the fact when you look at the numbers, you don't see that anywhere. Not in the current numbers, not in the previous ones, and not in the guidance. Even looking ahead, you don't see artificial intelligence eating Salesforce. Now, the man behind this note, the one that created all this fear in software companies, the one that's responsible for this last week's sell-off in companies like Intuit and Salesforce and Adobe and ServiceNow, his name is Ben Rietzes. And he's an analyst that published that note just recently. He's also the analyst that published this note not too long ago. This was earlier in 2025. How Google could go the way of Kodak. Google could be the next Kodak, and that's bad for Alphabet stock, an analyst says. Disruption is always a fear of technology investors, for good reason. The radio gave way to televisions, landlines to cell phones and flip phones and smartphones. Now chatbots using artificial intelligence are beginning to shake up internet search. A field dominated by Google, according to Melius research analyst Rietzes says that Alphabet is down 25% from recent highs and is still cheap for a reason. So during the very bottom of April, this was April 1st, almost at the very bottom, Ben Rietzes published a note comparing Google stock to Kodak. And this is the very same analyst, the very same research group publishing this long note saying that companies like Salesforce, Adobe, and ServiceNow are being eaten alive by artificial intelligence. Now, while this research by these analysts is thought-provoking and provocative, it's not always true. Google was never going to become Kodak. Not a chance. There was never a 1% chance that Google was a Kodak. Not the company that owns Google Cloud, that owns YouTube, that owns Waymo, that owns the leading AI models, that has billions of users of distribution. It's so much different than Kodak. It's almost insane to compare it to Kodak, but that's what this analyst did. And the same thought process is now being applied to Salesforce. People are acting as though Salesforce is going to be destroyed overnight. The artificial intelligence is going to eradicate this business. And that shows an incredible lack of understanding of how deeply entrenched Salesforce is, how difficult it is to move from the product, how most companies don't want to deal with recreating this product even through agentic technology. Most companies do not want to focus on it. They'd rather outsource their CRM management to a separate company that's proven, that's structured, that has all the tools they need. And I don't believe that this is going to be much different than his call on Google. Over time, quarter after quarter, this narrative that artificial intelligence is eating all these software companies will get crushed by the numbers quarter after quarter. As you go through the years and you see that these companies still stick around, they're still buying back shares, they're still profitable, their margins are ticking up, and they're incorporating many of these products that are supposed to kill them, you're going to see this narrative fade, just as you saw the Google becoming Kodak narrative fade as well. And that's why I just recently added to my Salesforce position. Obviously, I could be wrong. Maybe this time it's different, but I don't think it's going to be. Now, moving on, we get to this article published here by Bloomberg's Mark Gurman. He's the one that covers Apple. He always has the best coverage of Apple. And he outlines how Apple is now in the AI robots play. For a time now, I've been outlining Amazon as my go-to choice in AI and robotics. I think it's the best setup company. But now we have a new kind of entrance, a company that's been a bit forgotten about that's really trying to drive into robotics. That is Apple. Apple is plotting an artificial intelligence comeback with an ambitious slate of new devices, including robots, a lifelike version of Siri, a smart speaker with a display, and home security cameras. They also report that there's going to be a tabletop robot that serves as a virtual companion, as well as smart speakers with displays. Now, if we move on and we just go into these categories, they say that the home security system is seen as another big growth opportunity. New cameras will anchor Apple's security system that can automate household functions, an approach that should help Apple's product ecosystem become stickier with consumers. So they want to further entrench themselves in the home. You have the iPhone, you probably have a few MacBooks, you may have a couple iPads, you maybe have Apple AirPods, but now you might get the Apple cameras if they're well integrated. They'll probably integrate them into the Apple TV, the device so you can just display an array of cameras on your television if you want. I can already see the ways that Apple's going to integrate this, and of course with speakers as well. It's all part of an effort to restore Apple's mojo. Its most recent moonshot product, the Vision Pro headset, remains a sales flop, and the design of its best-selling devices has remained largely unchanged for years. This is the first piece of truly bullish news that I've read from Apple in some time. The first thing that has actually gotten me excited about the company. So far, Apple has been struggling for the past couple of years. They've, of course, struggled just competing with competitors in China, other phones. Then you also have the Vision Pro flop. You have Apple failing to implement AI into their smartphones effectively. They should already be smart devices, and they haven't accomplished that. So it's left investors wanting to know what they can latch onto. Where can they anchor Apple in the future? We see a company that's struggling to execute over the past couple of years. Laying out this ambitious plan of pushing full steam ahead into robotics and eventually implementing artificial intelligence into the iPhone gives people something to anchor to. Now, it's still up for debate of whether or not they can execute on this as good as possible, but Apple has time. It's a company that still maintains an incredibly deep moat. Everyone uses the iPhone. It is the go-to high-end product in phones. So Apple is still maintaining their moat. They have time. They can figure this out. And if they successfully expand their array of products into all of these robotics and home automation tools, I believe there's more upside for this stock. Apple could be really well positioned for the future. So it's a company that's going back on my watch list. Now, next we get to this news of Perplexity. Perplexity is like the Yahoo browser, the one that's AI enabled, but they don't really have their own models. They just plug in different ones. It's made a lot of noise because the CEO is very noisy. He likes to do a lot of publicity stunts. And he did another one. He gave an unsolicited bid to buy Google Chrome. And the bid was a massive lowball for what Google Chrome is actually worth. If we look at the details here, Perplexity bid to buy Google Chrome browser for $34.5 billion, which represents a dramatic moment for internet search giant a week before it celebrates the 20th anniversary of its IPO. Even if the analysts aren't taking the offer very seriously, Perplexity's move marks a turning point. It's the first time an outside party has made such a public and specific effort to strip out a key piece of Google, which currently awaits a judge's decision on whether it must take significant divestiture steps forward in its ruling. So right now, we don't know whether or not the judge will actually force Google to sell Google Chrome. Most investors do not believe that's going to happen because frankly, it doesn't make much sense. The arguments for selling Google Chrome are not good ones, and every third-party analysis confirms that. That's why most people believe that that sale is not going to happen. Now, what Perplexity is doing here is showing them to be more of what they are. People that like publicity stunts that in most cases shouldn't be taken seriously. The bid itself for $34 billion, which was completely unsolicited, is not only a massive lowball, it's way less than what Google Chrome is actually worth. If you were to put a more accurate bid, it would be north of $50 billion. So they're lowballing Google with this unsolicited bid, but they're also bidding twice as much as what their company's valued at. Perplexity's last valuation was $18 billion. The company likely runs close to a loss at this point in favor of trying to grow. So it's $18 billion and they're offering $34 billion to buy Chrome. So they have no money to buy Chrome. They're just saying we'll buy it and maybe we'll find some investors to help us buy it. But that's like me saying that I'll bid $25 billion to buy Chrome. And if they accept, I'll just find some investors to help me buy it. I have about the same chance and merit of buying Google Chrome with my portfolio of $1 million as Perplexity has. They have zero chance without substantial outside backing from multiple massive investors, to the point where they're not even the ones really buying Google Chrome. But that's not the only reason that Perplexity should not be allowed to buy Google Chrome. The bigger reason is they just don't deserve it. They frankly don't deserve Google Chrome. Why should they be allowed to control it? The CEO has never built something as big. He's never managed something with as many users. Google Chrome has billions of daily users, people that count on that browser. Perplexity hasn't ever managed anything that big or even close to that big for that amount of time. They've proven no history of being able to have good stewardship, take good care of a product, grow it that much for that long, to treat the people that use the product that well. We have no trust in them in the same way that we have Google. Google has proven excellent stewardship over Google Chrome. That's the reason why people still use it. That's the reason why even though you log into a Microsoft product, you buy a new Microsoft laptop, and Microsoft Edge pops up hoping that you'll keep it, wanting to be the default, inevitably you'll search Google Chrome and download Google Chrome, and then default Google Chrome. That's a type of loyalty that Google has built over a decade. And Perplexity, wanting to come out of left field to buy something they don't deserve, they can't afford, doesn't seem right. So hopefully Google Chrome stays with Google, where it rightfully belongs, with the company that's grown it carefully over time, with the customer base that's grown to love Google because of their stewardship over it, keeping it free and safe and constantly updated over time. But even if it does get sold off, the last people that it should go to are the people that are known for publicity stunts and trying to grab attention headlines at every opportunity possible, which is Perplexity. Now moving on, we get to my most recent holding, which is Duolingo. This stock has gone through a little bit of a roller coaster ride. After earnings, when I first bought my $10,000, the stock went from $330 to around $440. So it gained around 30% in value just in one morning. And then it slowly faded, and it faded all the way back down to where it was, and then even below where the initial bounce was. It gave up an entire 30% bounce in just a few days. When we look at Duolingo stock, it now trades around $330. Right back to where it was before. My holding in it, I think, is down around 5-6%, but it changes every day. This is a very volatile holding. It's a small market cap company, high growth, trades around anywhere from 5 to 10% swings per day. If we look at the history of this company, and even the 30% decline after earnings, when you look at the actual price history and price movements of this stock, that's not that unusual. In fact, it's quite common with Duolingo. Earlier in the year, it was $540. It came back down to $350. Before that, it got to a high of $440. It went all the way back down to $290. Before that, it was at $360. It went back down to $310. And then there's spikes all along the way. Back in 2024, it was at $244. It plummeted down to $176. That's a 30% decline. There's another 30% decline right here. More 10, 15% declines, all along the way of growing over time. When we look at the actual fundamentals of the business, like the subscription revenue, this is growing at 46% consistently over time. And this is what I'm more focused on, the actual growth of the company and the fundamentals. Now, one investor and analyst that I really respect, I've shown numerous clips throughout my series, is Mark Mahaney. You've seen him before. He's talked about Uber. He's talked about Meta. He's talked about Netflix. He's usually before a lot of companies that end up doing really well. And he outlines Duolingo as his current top pick in small cap tech.
Why is Duolingo your top pick for play for the small and mid caps? You like this?
Yes, and it's it's a little bit it's relatively small, but not that small. It's about $18 billion market cap name now. It's a language learning app, and it's a highly popular one. It's got about 30 million users in the U.S. and out of a global language learning market in the U.S. that I think is closer to 150 million, 160 million. So there's a lot of room for this company to continue to grow. It's had a lot of controversy recently. That's what we stepped in when we thought it was overly dislocated. They're also expanding into other verticals like math, music, chess, and I think they can do this a lot of different ways. Their core languages are English, German, French, Spanish, but I think there's about 30 languages you could spend time learning. And I think they're the leader in a segment, and they've still got very low share of their end market. So I think you're going to have premium growth, call it 30% revenue growth for a substantial period of time. That's rare air for most companies.
I got about 20.
So Mark Mahaney outlines this as his top pick. even though it was at $400 per share at the time of this clip. Now it's dropped down to $330. So it's at a better valuation today, and he has a price target for it at $540. Now, of course, there's no guarantees in the stock market. Maybe Duolingo really will be disrupted by all the AI tools in the future. But I think that's unlikely, and it's also nice to have someone else validate a thesis that you have. Mark Mahaney is one of the most well-respected analysts and researchers on stocks. He's had numerous good calls, so I like having him on my side on this one. I like to see that he's still bullish on this company, and he has a very high price target on it. So we'll see how this one ends up in the future. Now, moving on, we get to news that Amazon is doing a major push into grocery expansion. When we look at the details of this, there's certain companies that this may impact. For example, the analysts say that Amazon's move is a directional negative for Uber and DoorDash. He said it would add likely pressure on the margins as this update raises the competitive intensity to their intra-week delivery efforts. So all these companies are trying to do grocery delivery. Having Amazon brute force into grocery delivery certainly doesn't help the dynamics. When does it ever help a company to have Amazon fiercely compete in the same market? Amazon's willing to go through massive losses to lower margins, to go for huge gains in revenue at very low margins, which of course is difficult for these competing companies. But the one that's the most important by far, a company that's made a lot of progress in grocery delivery, and one that I believe is the biggest competitor to Amazon today, is Walmart. I think Walmart's the biggest competitor. When you look at the retail business of Amazon, Walmart is sneaking its way into online retail via grocery delivery. You have Walmart Plus. You can go in the app and just order all the groceries you want. There's these people that collect the groceries at Walmart locations. Then they use a delivery service to deliver it to you in the same day. Now, I don't know if you've been into a Walmart recently. Sometimes we go there, not often, but I still go there once in a while. And when I go into Walmart, I notice that around half the people shopping at Walmart are the people collecting for delivery services. It's a huge portion. Just go in one and look at what's going on. Everyone is going around. There's Walmart employees that have these huge carts and they're just collecting groceries to be delivered. But the Walmart Plus app is gaining ground through grocery delivery. This was a notable weak spot for Amazon. Out of my thesis on Amazon, this was actually one of the things that I was the most concerned about. So seeing Amazon push more into this, I see as a notable positive on the stock. Amazon said shoppers in more than 1,000 cities and towns can now order fresh groceries with same-day delivery. And then this is included in Prime. So instead of having to sign up for a separate membership to Walmart Plus, you can just have this bundled in with your Prime video service, your Prime 2-day shipping. Now Prime members are going to have same-day delivery services for free on orders over $25. Now again, you can talk about Uber or DoorDash, these delivery services. I don't think this is helpful to these companies, but ultimately the biggest competitor here that I believe Amazon is focusing on is Walmart. They know that Walmart Plus is gaining members. They know that Walmart is working its way into becoming a competitive service online. When people sign up for Walmart Plus, then they're in the app and they notice that you can buy other stuff just from the Walmart website, have that delivered as well. Amazon does not want Walmart to make substantial share gains against their first party and third party seller services. So now they're dealing with grocery, the big thing that they have to tackle. The one key advantage that Walmart has is grocery, and seeing Amazon go full force into this, I think is welcome news. Now moving on, we have another news item here. This is another big move from one of the companies that we follow. Paramount buys UFC rights for $7.7 billion for a 7-year deal. So this is about $1.1 billion per year that Paramount is paying to have exclusive UFC rights. This includes UFC's full slate of 13 marquee events and 30 fight nights. So this is everything. This is like the whole bundle. This isn't just their main events. This is all 30 fights. So it's basically like every week when you add this together, 43 fights. That's almost every week, give or take, that you have some event with UFC now on Paramount or Paramount's networks. Now, there's lots of companies that would have loved to have the UFC rights. Of course, Netflix was one of them, but you also have companies like Amazon that were surely bidding on it. You have companies like YouTube that were bidding on this as well. But you have Paramount winning this one. Paramount, which has the worst balance sheet of all of them, they're the ones that got the right. And that's because of this new deal and merger from Paramount. The owner of the company now has deep pockets and is bidding aggressively on these sports rights, bidding enough that no other competitor wants to even touch it. Because most companies realize that they can't make a lot of money with this type of property. Now, I own Netflix stock. It's still one of my largest positions. And when I look at the reasons that Netflix wouldn't want to buy this deal, I believe there's a couple of them. One thing is that Netflix is a heavily global company. They have so many viewers outside of the US. In fact, over half their viewers are outside of the US. The majority of this deal is exclusive rights in the US. So it wouldn't even be beneficial to the majority of Netflix's viewers. And I think that's one reason why they didn't go for this deal. The next thing is that it's absurdly expensive. Netflix has a content budget of around $18 billion per year over the next 5 years. This would be 1/18th of their content budget just on UFC rights alone, every single year for the next 7 years. And that's far more than Netflix likely wanted to spend on this deal. There's too much other stuff they could create, too many more series and content and things that they could create with $1 billion per year over a 7-year period. So I believe that the price being super expensive and the rights being exclusive to the US are different reasons why Netflix decided not to go with this deal. This will make it so that Paramount does have a consistent viewer base. Whether or not they can amortize this content and actually make money on it is a different discussion. Paramount already has struggled to become profitable, and this is going to put a lot more pressure on them. Now, finally, we get to this last bit of news here, which is a bit of a self-plug. We have Qualtrim, the software that I created, now making its way to national television. We have the show here, Making Money with Charles Payne on Fox Business. This is one of the business shows every day. And we have him referencing a Qualtrim chart. Some viewers noticed this, so I wanted to point it out. Here's the clip.
Right. Software as a service, the SaaS, these stocks are getting annihilated. We've got a table behind us, absolutely annihilated.
Let me, the segment's going over software getting annihilated, and that's been a subject I've been talking about. The chart being shared there in the background, you can see the Qualtrim logo on the bottom right, and that's the dip finder. The dip finder is one of the products we created in Qualtrim. It shows the price change over different time periods, momentum factors, visually illustrated. And you have hubs and Atlassian and CRM, you have Salesforce there, and all the different companies. So there you have it. Qualtrim has made it from YouTube onto cable networks. Who knows where it's going to go next? That's going to be it for this episode. Hope you enjoyed. See you in the next one.